Ladies and gentlemen, welcome to Woodburn Accountants and Advisors China webinar series on managing your accounting and tax in China. You have joined us for day 5, part 5 of this webinar series, where we are looking at developing profit repatriation strategies for your China business. It has been a fantastic week where we have really reflected on the tax side of things when doing business in China, everything from looking at profits tax, VAT, tax audits, internal control systems, and finally we're going to try and put everything together in terms of how you can get your money out of China. So let's get cracking. Many of you have joined quite a few of the previous sessions, so I do have an understanding and background of who you are. Again, for those of you that are brand new and haven't participated in the past, I always want to start off with this slide so I get an understanding about who is in the audience today. So if you are a newbie to China, meaning you found an opportunity or you're looking to gain a China education, then let me know. Type in newbie into the chat section of the control panel. If you are a startup in China, it basically means you've been transacting in China for a certain period of time, or you've either implemented an entity and you've been doing this for probably 1 to 3, 1 to 5 years, and your core focus has always been on the business itself versus any of the compliance that may be required. So if you are a startup, write that in the chat section. And if you're experienced China hand, this is obviously you've been in China for quite some time, you've been doing business in China for quite some time, and you're probably on here just to get some fresh ideas. But if you are an experienced China hand, do let me know, and let me know why you've joined. What are you actually looking for in terms of info and data? There's a lot of content to go through, so I'm not going to stop and pick people out, but I would love to hear from you and love to understand who you are. Again, I know quite a few people that are on here, so I know that the quantity of you that might be finance managers and those that are non-finance individuals. I have aimed to make this webinar as simple as possible for those of you that are non-financial individuals, so you have a clear understanding of how things work when we're talking about profit repatriation. But again, if you're new, do let me know a little bit about your background. How the webinar works is that I'm going to be here educating you on profit repatriation and everything that is surrounding it. So if you do have questions, you need something to be clarified, you didn't understand something, please put that into the chat section of the control panel. This is going to be about 60 minutes of your time spent, so use it wisely. It is Friday, I know, so you know, I'm lagging as well, but it will just be about an hour, and then we'll get through the whole presentation. So use this time to ask me anything you like, and I'll be staying on for the Q&A to answer everything. If you run into any technical issues, so if you run into issues either with your sound system or the connection, I can't help you with that. So just know we are recording it, and the recording link will be provided to everybody once it's up on our YouTube channel. If I run into any technical issues, just know that I need about 30 seconds to 1 minute to reboot. So please do stay on the line, time permitting, obviously, so that I can finish today's presentation. How can I help? Well, my name is Christina Kohler-Colucci. I'm the head of business advisory at Woodburn Accountants and Advisors. I'm 17 years in the corporate services and compliance sector in China. And my clients are 100% foreign investors who are looking to invest in the Chinese and Hong Kong market. And I'm also a creator of the China Roadmap methodology, which is a step-by-step plan for companies that are looking to enter the market or companies that are already operating in China, to give you an understanding of, or to provide you actually with a checklist of things that you have to do to make sure that your company is protected so that you can focus on a performing and growing business. If you are interested in joining that, it's going to be my last webinar for 2020. It's going to be on December 8th. It is a workshop. There is a lot of interaction. There's also a handbook that I want people to utilize. So you can go to our website at woodburnglobal.com/events. Go check out the chat section of the control panel, and you can register for that. We are going to be covering quite a lot of things today. So let's get started. So what are the concerns of most companies that are looking to do business in China? So the first question that I always get asked is, well, can I take my money out? Will I always be able to take my money out? Or will the Chinese government one day say, no, you're not allowed? Or, you know, what are the restrictions or regulations that are holding me from being able to take my money out? And there's this real sense of concern, worry, anxiety, fear, basically, of doing business in China and not being able to take your money out. So I hope today to be able to calm those fears, remove them entirely, and bring the whole 5 days that we did, the whole 4 previous days, into one big topic, all around tax planning and then ways of getting your money out, okay? But there are complexities surrounding getting your money out. So one of the biggest complexities is that regulations do change constantly. Regulations are different from bank to bank. Regulations are also different from city to city in relation to how you are able to utilize your funds and get your funds out, okay? Another item that you have to all remember is that there is also a lack of Forex in the Chinese market. So if you want to be able to transfer your funds out, or even funds, well, no, let's just keep it as funds out in a foreign currency, it is going to take time. Will you be able to do it? Absolutely. You just need a bunch of patience in order to be able to get that through. And I'm going to be going through the complexity of the procedures, step-by-step procedures, the document list, the minimum document list that you will need to get the money out in the variety of methods that I'll be highlighting today. Okay. Now, like I said, it's not always straightforward. It's not a very simple document list, and then you hand it in. You will be asked for considerable documentation constantly until the bank feels like they can process it and transfer the funds, okay? What I want to highlight basically is the following. There is a guideline, an operational guideline to get money out of China. The key is making sure you don't fake it, okay? We want agreements and contracts to be as authentic as is possible. Ideally, you want them to be 100% authentic so that you have the ability to provide evidentiary proof or reason as to why you're doing the transfer to the bank or the tax bureau in order to be able to transfer the funds out, okay? Now, why is developing profit repatriation strategies important for your business? Well, one, I didn't add it here, but it removes the anxiety and it removes the fear. Creating these strategies basically allows you to know that there are contracts that are in place that have been registered with the tax bureaus, that at any point in time you can issue an invoice based on those agreements in order to get funds out, okay? It is a way for you to also create true and authentic agreements so that you have tax optimized structures, okay? You know, during COVID, your business in China may have been doing very well, but you may have required some of those dividends or some of that capital that's stocked up in China to be utilized in other subsidiaries around the world that are suffering more deeply than China is, okay? But what I also want you to be aware, and I was really trying to emphasize this in the first webinar of this week on Monday, is that it aids in giving you a choice. Nobody is asking you to take your money out of China. You have this emotion, this negative emotion that is telling you you should take your money out of China, but nobody's forcing you to do it, right? And this is where problems arise, because perhaps if China is an expanding market for you, you need to keep those funds in China for further expansion, okay? So developing those strategies, I think, is more of an emotional component in terms of easing your anxiety, knowing that you've got contracts in place, they're registered with the tax bureaus, with just a simple invoice and supporting documentation, you can get funds out. But I just want everybody to be aware, you don't have to take your money out, okay? I certainly did not in probably the first 15 odd years, so maybe even just 2 years ago, out of China, because we were expanding so big in China. And I needed those funds for that expansion, okay? Now I want to, there's enough of you on today. I've never done a poll before, so I thought I would do a poll today. And this is my first time, so bear with me. I'm gonna launch it. And the big question is, are the authorities in China familiar with tax structures, okay? And I would love to know what your belief is. Do you think yes, they are, no, they're not, or you're not sure, okay? I'm going to give you guys, we're starting to collect responses now. I'm going to give you guys a couple of seconds to see what the results are. Please do participate because it always does help to get an understanding of the full picture of what people's points of view are. Okay? Only 50% of you have voted. All right, guys, come on. A couple more seconds and I'll get that done. I'm not sure where I should be clicking right now. Oops, sorry, that wasn't right. Let's go here. Maybe I have to close the poll and share it. Let's see what the outcome was. So in terms of the polls, 75% of you said yes, and 25% of you said not sure. So thankfully, nobody said no. So that's a relief. But 75% of you said yes, and you are absolutely correct in that. The tax authorities in China are becoming more and more familiar with the concepts of tax havens. They are getting more and more familiar with the concepts of you want to get your money out of China, and that you're developing profit repatriation strategies that are pretty creative in some cases to get that money out, okay? Now, with the fact that the tax officers and tax bureaus in China are more knowledgeable than ever before, this just leads you into 4 things I want everybody to remember. 1, you're going to have to create true, authentic agreements and contracts that are valid. I've used UK as a jurisdiction today because that's where the majority of my registrants are coming from. But imagine your head office is in Hong Kong or is in Germany or in the US or wherever else. I've used UK to make it a concrete example. You need to have these agreements valid in both China as well as in the UK. You've got to be smart about this because you really cannot fool the tax authorities in China any longer. You don't want to mess with them. You don't want to provide them with supporting documentation that is fake, okay? You've got to keep in mind that when you're developing profit repatriation strategies, that the company that is receiving those funds has to be an entity that has commercial and economic substance, i.e. it's not just a holding company. And you've got to understand that there are Forex issues in China, meaning that if you are going to be repatriating in foreign currency, there is a lack of foreign currency in China. So and depending on the value, it might take even longer for the bank to be able to acquire it, and as a result, take longer for you to be able to repatriate those funds. I have had situations where it has taken more than 6 months to repatriate based on a repatriation agreement, and everything was authentic, okay? So be aware of the length of time and definitely have patience around this. Now I'm going back a little bit to Monday's session because one thing that I really want to highlight is everything that is to do with tax planning. So the basic requirements in China is that you have enterprise income tax, corporate income tax, profits tax, however you want to call it, and this is set at a rate of 25%. And as I highlighted on Monday, there are exceptions for SMEs, exceptions for high-tech companies, there are exceptions for companies that are located in specific zones, there are companies that have exceptions also if they are in specific industries and sectors. Okay, so software development, clean tech, etc. Now, before distributing after-tax profit, foreign investors are required to make up any losses that have been carried forward from previous years. So the standard is 5 years of loss that can be carried forward. The year of 2020, it's going to be 8 years. Okay. Now, in addition to all of that, all right, so this is the standard, right? you have profit sitting in your company, right? You need to decide if you go the transparent route, you are going to declare it. You're going to pay profits tax in China. So whether that is 5, 10, 15, or 25%, depending on your situation. And then you have to put a certain level of funds into a reserve fund, enterprise development fund, or into staff incentive and welfare funds, which I'm pretty sure a lot of you were not aware of, okay? So in terms of the reserve fund, which is the main fund that is mandatory, all of the others are optional. You need to allocate 10% of your after-tax profit to the reserve fund until that reserve fund accumulates 50% of your registered capital. That reserve fund is really, from the government's perspective, a fund if you go into bankruptcy, if you get sued, then it's money that will be utilized to pay off employees, etc., pay off any of your debt. All right. So I want you to be aware of this reserve fund. In addition to that, anytime you are creating company interrelated agreements, you have to consider transfer pricing. Okay. Now, local files for transfer pricing are only required when you are able, or when you achieve, one of these 4 options. So I've highlighted in red the most common one that occurs, which is when you have sister party or interrelated party transactions that exceed 40 million renminbi in a fiscal year. Okay. Then you have to create a transfer pricing local document, and you will be investigated based on your transfer pricing regulations. Okay, so please be aware of that as well when you are creating these profit repatriation strategies. What you also, so these are kind of all the things you have to think about. First of all, you have to think about profit. Do I have some? Second, you have to think about, let's go back the slides, reserve fund. Am I going to put it in there? Then you're going to think about transfer pricing. And then, have I done it? If not, oh dear, I'm going to have to do something about this. And then you've got double taxation agreement. Okay, so this is sort of your checklist of things that you have to think about. Okay, now again, I've used the UK as an example because that's where the majority of people on here are from. In terms of the double taxation agreements, you have to look at the last column on the right, which is the new DTA rates. I shouldn't really be using new, but it just helps to extinguish, show very clearly what are the current rates. I should probably say that to current rates for dividends, interests, royalties, and capital gains. Okay, so depending on whatever country you're from, if you're from, I don't know, the US, from Germany, France, from any of the Scandinavian countries, there are DTAs that exist with China. So please do investigate those to understand what would be the applicable rates for you. Okay. And then, I mean, I really emphasized this on Monday, but I'm going to re-emphasize it again today. What is your tax plan? When will you make profit in China? When people are at that stage of, which is the pre-investment stage, and they are about to incorporate their entities, their biggest concern is the profits tax. So I usually create a scenario for them where I highlight year 1, year 2, year 3, year 4, year 5. And I did this for the webinar Monday. So if you missed it, do go back to that. But in many of the scenarios that I create for companies, they're probably not going to be profitable until at least year 5, year 6. Okay, so if it's going to take you a while to be profitable, then thinking about profits tax and thinking about profit repatriation strategies, why now? Right? My assumption is that for most of you that are on here today, it's because you are at a point where you have capital that you want to be able to repatriate. Okay, and like I said, this is really an emotional aspect of the business because there is a level of fear when going into the Chinese market about how you can get your money out. So to calm that fear, I do tell companies in year two, at the early stages of year two, to start developing profit repatriation strategies so that they are ultimately developing a tax plan. That's my underlying motive, is to make people create this tax plan so they have an understanding at what point they will want to repatriate. But let's just go now into the methods for repatriation. And I hope everybody has understood why I've emphasized this whole tax planning perspective, having a clear idea, even if it's just superficially, what your plan is for year one, year two, year three, year four, year five, because like myself, I never took money out. I had to keep it in China in order to be able to use those funds to expand, okay? Setting up additional branch offices, hiring more people. There was a lot of investment that went into my growth, okay? And you have to make that analysis when you're creating that tax plan. But let's start coming to the methods for repatriating funds. And the first method is obviously the most transparent one, which is dividend repatriation. But it also means you have paid profits tax at whatever rate was applicable to you. Let's just use the average, which is 25%. And you've got money left over after that. So what does that mean? It means that the after-tax profit, there are criteria. First of all, you need to make sure that registered capital has been injected in total, the prior year's losses have been made up, and that the capital is in the statutory reserve funds before you can even consider dividend repatriation. So you have to fulfill those three criteria before dividend repatriation even comes into play. Okay, and again, I've only started this process 2 years ago. Okay, so, and that's because I had to make up my registered capital. I had prior year's losses. I had statutory reserve fund. It took me a while before I ever even did a dividend repatriation. Okay, so be aware of the timing that is associated with this. When you are doing a dividend repatriation, okay, you go back to your double taxation agreement table, and our table highlights that there is a 5% withholding tax imposed on the dividends distributed to the investors in the UK. This 5% is only applicable if that shareholding company shows economic and commercial substance, i.e., it is not a pure holding company that has zero transactions running through it. The Chinese government, being fully aware of tax havens, they are so familiar with countries like Guernsey, Isle of Man, Seychelles, Mauritius, British Virgin Islands, etc., right? They, in some instances, they even consider Hong Kong and Singapore as tax havens, okay? That they will ask for supporting documentation to get a picture of the UK company for the latest audit report, the previous month's balance sheets, P&Ls, whatever it might be. And the reason why I say this is because if you are repatriating dividends to a UK company and you cannot show economic and commercial substance in that shareholding entity, the 5% won't be applicable, it'll be 10%. So you won't get any savings, okay? And since historically most people were setting up holding companies in Hong Kong, just so you know, the double taxation agreements are pretty much all aligned country by country, whereby if you can show commercial and economic substance in the shareholding company, 5% is pretty much the norm. Whether it's Hong Kong, UK, Germany is the same. I don't know the US by heart, but most European Union nations are all with the 5% rate. Okay, but you do have to show additional proof for the economic and commercial substance. Now, when you're doing a dividend repatriation, the first step is actually getting approval from the tax bureau, because they want to make sure that all of your profits tax has been filed according to PRC GAAP regulations, declarations have been done, and payments have actually been processed. So what the tax bureau will ask as supporting documentation, this is just a minimum, is the annual audit and tax compliance documentation, a resolution by the board of directors or executive director that distributing profits as dividends is allowed, is showing that you have applied for the DTA benefit, so having that approval document from the tax bureau to highlight that. The filing of the profits tax return, record filing, so if the amount of the dividends to be transferred is over 50,000, it's the record filing of that with the tax bureau. And then finally, the bank payment. So you have to show some documents from the bank, not all, some of the documents from the bank to initiate transfer. You have to show that for the approval process for the tax bureau. Okay. Then you go to the bank. So once you get the approval from the tax officers, you go to your bank, and the bank will ask you for additional documentation that has to be verified. So there's an application form. They will need an additional signed resolution. They will need the audit reports as well. They will need the tax record filing form as well. And they will need proof that the registered capital has been paid and the reserve funds have been allocated. Once they have all of this supporting documentation, they will then approve. They may ask for more, but they will then approve, and the bank payment will be processed. And then at that point, depending on which currency you're transferring in, that you have to go through this Forex application to apply to get Forex to make that remittance. That's not part of this process though. Okay, it's separate. So it's tedious. I hope you guys are realizing that. So when you are thinking about dividend repatriation, first of all, you've got to think about your tax plan. Are you just going to start paying profits tax? What are you going to do with the remaining amount? Is it going to be utilized? You know, has all the registered capital come in? Has money gone into the reserve funds, etc.? You know, you've got to think about all of these things, and then you have to go through the actual application. All right. Now, dividends, as you can see from the process, the dividend repatriation, if you look at a fiscal year, so fiscal year in China is January to December, it means that your annual profits tax return has to be filed by April 30th. The annual corporate services have to be filed by June 30th. It's only after this time that you have the ability to start the dividend repatriation approval process. Okay, it can only happen once a year. And you can start that then between the period of July to December. There are other forms of repatriating which can be done prior to declaring profits tax. And today we will be going through these types of agreements. So the second method is in relation to service fees. And there are a variety of different agreements that you can come up with that obviously have to be true in order to be able to repatriate funds, again, prior to declaring that profits tax. So you can have marketing service agreements, management service agreements, technical service agreements. When you are drafting these agreements, you have to think about the transfer pricing model. You have to realize that the contracts have to be minimum in Chinese, so obviously having it in a bilingual format will help from a UK perspective as well as from a Chinese perspective, okay? And when you are creating these agreements, you need to be aware of permanent establishment guidelines as well, which are also highlighted in the DTAs between the various jurisdictions and China. Now, one thing that I want to mention about these agreements is that, and I'll use the management service agreement as an example, is you will have to provide supporting documents. So when we were talking about a management service agreement, in my mind, that means that for the senior management or whatever management that has traveled from overseas to China to help facilitate the operation of the organization, that entity overseas is going to issue an invoice to China for, I don't know, the full day spent by that employee in China, hourly rate, plus then all the additional expenses. And then you'll have a markup like a 5%, 10%, whatever it might be, okay? Because you have to follow the transfer pricing regulations. So the evidentiary proof will be that the tax officer wants to see the passport copies of the managers that have traveled to China to verify that they've actually gone, they've actually spent time in China, and they will verify it through the entry and exit stamps, okay? So you have to realize that you can't just fake it and say, yeah, I had a couple managers coming over. and they never came over, but you're invoicing for it, okay? If you're using managers overseas that are working predominantly for the China business, and you have an agreement highlighting that they're based overseas, they're not traveling to China, there will be further supporting documentation to prove that they are really working on China. For example, you may have to provide email correspondence for a certain time frame to show really that they are active with the Chinese market. Okay, so what are the tax considerations when you're creating these service fees? Well, first of all, if the service that is being offered is actually happening outside of China, then potentially there'll be no VAT. So the VAT could be refunded or exempted, okay? And the VAT would have to be paid by the Chinese company if VAT is applicable. So the VAT that would be applicable would be, because it's a service agreement, if you are looking at a 6% VAT plus surtax. So generally I raise that up to 6.8%, and that is if you have the status of a general VAT taxpayer. If you're a small scale taxpayer, it would be 3.5% VAT and surtax. Currently under COVID, it's 1.5%, okay? If you don't know what a general VAT taxpayer is or a small scale taxpayer, please look at Tuesday's webinar session because I defined those and explained what those were. So there will be VAT applicable, and there will also be the withholding tax that will be applicable, which the rate will be dependent upon the double taxation agreement. So if you're looking at the table from China, UK, it's at 10%. And that is usually, I mean, Hong Kong has a lower rate, which is 7%. So again, you've got to investigate your double taxation agreement accordingly. Then you've got the outbound process, okay, which is the contract registration, which takes forever, which is why in the tax planning session on Monday, I was highlighting to probably start off in year 2 with these contract registrations, because it does take around 6 months to get them approved, so that you don't have to worry about it. It's registered, it's done. If amendments have to be made, you just go to the tax bureau, explain those amendments, and then you have supplements to the main agreement. But once it's registered, you get a number on it, a contract number from the tax bureau that it's done, so that ultimately when you want to do a transfer, it's just you raise that invoice and you provide the supporting documentation based on that invoice. When you're doing that contract registration, you at the same time apply for the DTA benefits. If you're not proactive in that, don't make the assumption that the tax officer will grant you that. So when you're registering the contract, you also register for the DTA benefits at the same time. And you explain to the tax officer, it's a UK company, it has commercial and economic substance. What proof do you need me to show you that there is economic and commercial substance? And you go through that process at the point that the contract registration is occurring. Then at the point that you have actually an invoice that needs to be transferred, you also have to show the filing of the profits tax return, the latest one. If the amount is over 50,000 USD, you have to do a record filing with a tax bureau, and then you have to show certain documents from the bank as well. Then you go to the bank, you show the service contract that has the tax stamp on it that has approved it, you show the invoice or the payment notice, and then they will probably ask for additional documentation to show proof. Okay, so be aware if you're doing management service fees, you've got the invoice raised, be prepared that the tax bureau or even the bank will ask for additional documentation. Okay, the third method that we are moving on to are royalty fees. Okay, and the easiest repatriation method you can create is a trademark licensing agreement, assuming you have registered your trademark in China. This is not something, I mean, when I talk to companies, the first step about China market entry is registering that trademark, okay? You want to get that trademark registered as soon as possible, knowing that it will take about 12 to 18 months to get it registered, okay? That's the simplest one. Why? Because the only supporting document you have to provide is the certificate of the trademark license, proving that the UK company owns the trademark. So when I do trademark registrations for clients, one of the biggest, especially those that have already incorporated in China, is they will say, oh, well, China will own the trademark. And I'm sort of like, okay, that's possible. Is that what you want, though, in order to be able then, you won't be, China owns it. So there's no licensing agreement. So how are you going to work out these types of trademark licensing agreements? It can only work if the UK company owns it. Now, if you are in the high-tech sector and you're trying to get the profits tax rate associated with high-tech enterprises, in that scenario, the trademark has to be owned by the China company. So that's then a trade-off, right? You have to make a decision. Who's going to own it? All right. What's more beneficial to you, that 15% profits tax rate or getting this type of profit repatriation strategy set up? And again, with royalty fees, you've got to get the transfer pricing model up. And the contracts also have to be in a minimum in Chinese language. From a tax consideration aspect, it's very similar to the service fees. You've got the withholding tax rate, and then you've got the VAT and surtax that is also applicable. Again, all the examples here are if you're UK-based shareholder, okay? VAT can only be refunded, exempted if the actual service, like the technology agreement, is outside of China, okay? So keep that in mind. Again, outbound payment process is identical to the service fees. It's tedious. You need to get that contract registration up and running as quickly as possible, so it's done. You want to apply the DTA benefits at the point of the contract registration. You want to file the profits tax, do the record filings at the point, obviously, when the invoice is raised for that payment to be made. And then I've just highlighted here, what is the process to get the contract registered? So, because that in itself requires documentation. Like I said, everything in China is very bureaucratic and you have to be aware. What I'm liking though, and what I'm hoping that this presentation shows you is that there are guidelines, right? You might not always have the right document list, but you will have guidelines to be able to follow them, and then sometimes you'll be taken off the path. So in terms of the contract registration process, there's going to be an application form that the tax officer provides you. They will want to see the original contract. They will want to see the business license of the Chinese company, the business license of the shareholding company. They will want to understand how you have formulated your fees around that contract. So for example, if you've got a trademark licensing agreement, how have you thought through that rate that you have decided, whether it is a fixed fee or whether it's a percentage of something? How have you come up with that? Okay, it's basically a statement of the commission calculation, all right? They will also want the latest audit report, and then obviously they want the trademark, the certificate of registration. Okay, you give all of those documents plus potentially more to the tax bureau, and that's the contract registration. It does, like I said, take approximately 6 months to get those contracts approved. So those are, for me, the three main methods of repatriating funds. It's dividends, which obviously you're paying all the taxes along the way. You're also getting stuff into the reserve fund and all of that. Or you have the service fees and the royalty fees. During the financial crisis in 08-09, there were other types of repatriation methods that were created because of the climate. One of them was capital reduction. So when you are incorporating your company in China, you have to state a registered capital. And if you haven't calculated properly, you might realize that, okay, if you invested $1 million US, you don't need that full 1 million USDs, or actually, you're actually downsizing the operation, so it'll never come in. So you want to go through an application to reduce that to, let's say, 250,000 USD. You're making the assumption, though, that less than 250,000 USD has been actually transferred into the account. Okay, You have to reflect that on what has already been transferred over. All right, so that's the capital reduction. Very difficult application to go through because what the Chinese government wants is obviously greater investment. In 08-09, it became very common for the Chinese companies of foreign investors to acquire assets overseas because the capital was sitting in China. It wasn't sitting anywhere else. In the same light, it was also found that the Chinese company was providing offshore loans to the overseas shareholders so that the overseas shareholders could maintain their businesses. A fourth option is also adjustment to the transfer pricing models, which can also be created over time. That's strategic. It's a very strategic method. And then obviously other types of offshore investments. Now, would I recommend that today? I mean, I'm saying that now that there's another crisis in terms of the COVID-19 pandemic, but you know, ultimately, you may not necessarily think from a tax optimization perspective and an ownership perspective that you would want a Chinese company to own assets or provide loans overseas. Having said that, though, as a lot of companies in China are looking to have additional Chinese investors, it might make sense that those Chinese companies start acquiring things abroad, because that Chinese company has a profile that is more Chinese oriented than foreign invested oriented, because there are more Chinese investors than foreign invested investors. I hope I'm making sense there. Do let me know if I haven't been clear on that point. Leading on, what are the suspicious signs for tax evasion by the tax authorities? Like I said, our goal is not to evade taxes. Our goal is to optimize our tax situation. So there are a couple of things that are red flags for the tax authorities. The first is if you have significant amounts of interrelated party transactions, okay? This is where definitely that's a red flag, especially if it's the same party that you are constantly transferring out to, all right? So don't be surprised if the tax bureau would come to you questioning, why are you sending so much capital out? For what reason? Let's investigate this, okay? Because like I said, they do this investigation per transaction, per contract, but when you have an overview of it on an annual fiscal year basis, that question should pop up. In addition, if you've got long-term losses of low profitability or fluctuating patterns of profit and loss, this is also a red flag for them, okay? So one of the things that I highlighted on Monday's session was, even if you are profitable, you may want to think strategically that at some point you declare profit and you pay profits tax, and you start that whole procedure about carrying losses forward and putting things in the reserve fund, etc. For this main reason, that you want to avoid any suspicions from the tax authority. So as part of your tax plan, you should be raising that question: at what point does it make sense to just show profit versus trying to get everything out of the country? Okay. Again, we want to avoid suspicions and we want to avoid tax evasion. As part of Tuesday's session, I was reflecting on something called big data, which is where the tax authorities use 4 methods of basically comparing standards. And one of those methods is looking at your competitors in China and looking at the industry standard, and with your competitors, understanding if you are at the same level of them in terms of profitability, if you are at the same level as them in terms of loss, whatever it might be, okay? That you have the same level of margins in terms of your transfer pricing regulations. They will look at all of this. So obviously, if you are below average profitability compared to your competitors, this is also a red flag that will be raised by the tax authorities, and they find that information out via the big data. okay? If your shareholder is also in a jurisdiction that is considered as a tax haven, you will be investigated more. So the main tax havens as we know it, I'm going to just list a few, are places like BVI, Seychelles, Mauritius, Isle of Man, Guernsey, places like Luxembourg, Ireland, and also places like Hong Kong and Singapore. Not that it's bad to set up in any of those locations, but if there are, consistent and continuous business dealings with companies that are established in those tax havens, you will just simply be more investigated. Then if I gave you those trigger points, right? Those 4 trigger points on the transfer pricing page in relation to the local files. And if you are triggered by one of those items, so the one that I had highlighted in red was that you have intercompany related transactions that hit renminbi 14 million, and you cannot provide in a very short period of time transfer pricing documentation that will be requested by the tax bureau, so it's absent or incomplete, that will also be a red flag, meaning you haven't considered transfer pricing at all. Okay, and that leads on to obviously the last one, which is the arm's length principle. Okay, so keep all of these items in mind. I'm hoping that today's session, if you did join the previous 4 ones, provides you with a nice overview of how all of these things add up with each other to then being able to get profit out of the country, okay, strategically in a tax planning format. All right. So some of the tips that I want to give you in terms of setting up these profit repatriation strategies, and like I said, for many SMEs, it is an emotional aspect to their business because they want to know that they can get their money out. All right. So, the first year of your operation, you're probably going to be so focused on your business that, I would probably say in early year 2 of operations, start creating these agreements and contracts. Create true and authentic agreements and contracts that are pertaining to your business. First one, the easiest one, trademark licensing agreement. Okay. Don't forget to get these agreements signed up, contracts done, reviewed by tax advisory firms or even tax lawyers locally in China, as well as in the jurisdiction of where the shareholder is. So in the UK, for example, you want that agreement to be bulletproof so that there is no hiccups on the China side, obviously, which is what I'm advising on, but also on the UK side. Okay, don't forget that aspect. Another thing that I want to highlight is with the tax bureaus and with any other government bureau, mind you want to choose your battles wisely. Okay, so if in your year 1 of operation, you are fighting your tax officer about just everything, your tax officer will consider you, first of all, pardon my language, to be a pain in the ass. They may have lost face in some of those battles that you were continuously fighting them on in that year 1 of operation, which just means that at the point that you want to actually get these agreements and contracts approved, he is going to be a tough nail on you, okay? Because previously, historically, these types of agreements, all faked. Any company, you can talk to multinationals, they won't reveal it to you, but I guarantee you, multinational companies all the way down to SMEs were creating fake contracts and agreements to get money out of China. And in those days, the tax bureaus were not knowledgeable. They didn't ask for supporting documentation. It was actually a swift and easy process compared to what it is today, because they don't want money leaving China. They want money to stay in China. They want you to pay the full profits tax rates in China versus optimizing it and getting your money out at lower rates. Okay, so that's why it takes 6 months. They will make your life difficult. And if you haven't formulated a good, solid relationship with your tax officer in that year 1 of operation, he will make your life very difficult when you're trying to get these agreements all signed up and done. Okay, that relationship you're formulating with your tax officer is key to everything that you're trying to build up from your tax planning side. Okay, so you've got to be smart and choose your battles wisely on what you want to fight for. Not just with your tax officer, but then with your tax officer's boss, and maybe the boss are up, everything up that ladder of hierarchy. Okay? You can't win every single battle. Sometimes you're going to have to give up, and maybe you will have to lose face a little bit just to even out the playing field, right? It's a strategic tactic. I don't know if this is what people do in the UK. I've done 17 years of this with the tax officers in China, so for me, it's the norm. But you know, you want to be able to choose your battles wisely. You don't want to fight every single time. Conduct the contract registration as well as the DTA rates registration all at the same time as soon as possible. You want to get your contract registration number so that as soon as you raise an invoice that applies to it, it's a much swifter and faster process to get the payment out. Okay. Obviously, apply to the tax authority for the tax assessment during the contract registration. Apply for the treaty benefits. And when you're choosing your bank, or you can, even if you have a bank in China now, you can start having these discussions with your banks to understand what are the steps to do an overseas payment if you haven't done that yet. Okay, it is, again, pardon my language, a pain in the ass. It's very difficult because sometimes you'll even find bank officers, if you don't have a relationship manager, you'll have bank officers who have no clue what you're talking about, don't even know the document list. By the time you get the document list, it's been 1 month. So, you know, start having these conversations, bringing up these things so that the banks are prepared, but also you are prepared because you've eliminated that time spent. Okay. So that's the end of today's presentation. I would love to know, what were your takeaways from today? What did you learn? It always helps me to be able to restructure these types of webinars in the future. So if you can give me a bit of guidance, that would be wonderful. Just type it into the chat box. What was your key takeaway from today? You know, I would love also for all of you to have an action plan from today's webinar. What action are you going to take from what you've learned today? And then for those of you that have been joining all 5 webinars, I would love to know what has been your overall takeaway from this entire webinar series. Please do give me feedback, whether you enjoyed the subject, whether you were educated on it, what should I do differently? Are there other topics you want me to hit? Type that into me as well, because that's always very, very helpful. This is my action plan, actually, what I should be taking away from what you're telling me in terms of the activities. So, so Hari was just highlighting that he has to admit that he didn't realize the processes which need to be followed to ensure the lawful transfer of profits outside of China. Yeah, it's not so easy. And actually, Hari, that brings up a point that I do want to raise, because there are companies that don't have establishments in China, and they simply transact with China, meaning, let's say the UK company issues an invoice for services to a Chinese company. Everything that I've highlighted for the processes for profit repatriation, that's the same process for a simple overseas transfer that your Chinese counterpart has to do. Okay, that service agreement has to be registered. Takes forever. Supporting documentation needs to be provided. Taxes have to be paid before the transfer can be made. So, you know, whether I'm talking now about you having an entity in China, or whether I'm talking about you simply transacting with a Chinese company, these are the exact same processes that have to be applied for. I appreciate your takeaway. Thank you so much. So just to highlight how we can help you, and this is basically a guide of, you know, everything we can do in terms of implementation and growth, which is milestones 2 and 3 in the China roadmap methodology, which is everything from budget creation, validation, tax advisory, implementation of ERP systems, full or partial outsourcing of accounts, tax, bank, VAT, payroll, etc., creating operational guidelines and directives to have internal control systems, doing health checks or spot checks. We even do inventory checks, doing internal accounting, tax compliance reviews, and then we also help to design these profit repatriation strategies that I highlighted today. So we're going to move now at some point to the Q&A. We're going to move on to the Q&A. But just to let you guys know, if you want to jump on a 15-minute game plan session to talk about your tax planning or to talk about any questions you might have about profit repatriation, you can do so by clicking on this link that I'm going to give you right now in the chat section, which leads directly to my diary, and we can jump on a 15-minute call to just discuss your game plan and your action plan in relation to tax planning or profit repatriation. No, besides Hari's wonderful takeaway, there's been no other interaction at all. So if you guys do have questions and you want to quickly type something into me, please do so. I'll be sticking around, but nobody else has actually interacted. So I'll just move on quickly. Like I said, if you want to set up a call with me, just click on the link. In addition to that, if you are on WeChat, we have a China Roadmap community that is a great community for networking purposes, for asking questions where you want some advice, not just from an advisor, but from people that are actually operating in China. You can connect with me on WeChat. I'm going to give you my WeChat ID through the chat section. And if you want to join that community, let me know and I'll add you in there. And are you ready for our last workshop of 2020, which is all about your China roadmap? Again, you can go to woodburnglobal.com/events if you want to register for it. And just so you know, in January, February, and March, we've got our upcoming series for 2021. January will be about branding, your branding strategy for China, and I'll be having a couple of guest speakers as well as a client come on. I'll be February talking about market entry strategy, and in March about setting up a company in China. I haven't set up those individual ones yet on the website, so don't look at that website link. I made a mistake there. We're still trying to formalize the actual sessions that will be occurring. And if you guys have suggestions, you know, I'm really, really open to hearing from you to know what topics you would like to hear about in 2021 about China. So either type to me now, I'll be hanging around for another 5 minutes, or you can email me as well. I'd like to thank everyone for joining me in today's session. And also thank you to those that actually participated in all 5 days. That's absolutely wonderful. And I hope to see you on December 8th for the China Roadmap Methodology webinar workshop. Take care and goodbye.